Hello and welcome everyone. I'm Patricia Kingston and I'm the Corporate Events Officer at Tourism NI, and I'm absolutely delighted to welcome you today for the first of our TED Experts webinars for this year's Tourism Enterprise Development Programme. We're joined today by Financial Management and Corporate Governance expert Tony Haren from Admor Business Solutions, who's going to be delivering both sessions in our Business Finances series. Tony's delivered a number of really useful sessions for us in the past, so we're very happy to have him back today to share some more of his practical wisdom with us all. During today's session, Tony will be taking a look at each of the main taxes, so income tax, corporation tax, VAT and PAYE. Also, although not actually a tax, he'll be touching on national insurance for us as well. Tony will also kindly be staying on at the end to pick up any questions you might have, so please be sure to pop those into the chat box in your control panel at any time during the presentation, and we'll be picking up as many of those as possible at the end. So Tony's informed me that we have a really full-on session ahead of us today with lots to fit into our time here this morning. So without further ado, we'll get straight to it, and it's my great pleasure at this stage to hand you over to Tony to kick off today's main presentation. So good morning, Tony. Over to you.
Good morning, Patricia, and thanks very much for the introduction there. Good morning, everybody. I hope you're all well. And you're very welcome to this TNI organised webinar on business taxes. A little bit about me, first of all. Some of you may know me already. Tony Haren, Admor Business Solutions. My background is really in finance. I used to work in banking in different banks in Northern Ireland, and I'm a chartered accountant, chartered management accountant by profession. But a lot of the time, now I currently work with small businesses, small and medium-sized businesses on financial issues, anything to do with finance really. At the end of the day, I look at business planning, pricing, cash flow management, and anything to do with bookkeeping, sort of helping organisations to improve their bookkeeping systems. And I also do a little bit of work on corporate finance, or corporate governance with charities as well. So my background really then is in finance and corporate governance. So this morning's webinar is going to be about organising your business taxes. We're just going to have a look at a couple of polls here just to get an understanding of the audience is like. So we're just going to launch those polls now. First one is on business structure. So you just answer that question just so I get a sense of what the audience is like this morning in terms of what your business structure is. Okay, so we've got our first poll results up there. So 61% sole traders, small number of partnerships as well, limited companies, many charity social enterprises, and some others in there as well. So the majority of people on the line are sole traders, and partnership limited companies about the same. Okay, that's great. We could maybe do poll 2 now. This is just get a sense of how many of the attendees are VAT registered, so if you wouldn't mind selecting one of those. Okay, so yeah, again, a majority of businesses are not VAT registered, and well, we've got maybe a third, just almost a third there who are VAT registered, so that's good. You've got a range of businesses who are and aren't VAT registered. So yeah, we carry on now just with the presentation. So what we're going to be looking at today is business taxation, and the operating word really is managing your business taxes. Well, managing is a key word there. So we're going to look at it in a structured way. Tax, to be honest, is a very broad subject, and we're going to try and squeeze into an hour a good overview for small businesses, small and medium-sized businesses, about what you need to know about taxes, and importantly, how you need to manage them. We could probably spend an hour on each of the taxes easily, and therefore it's going to be there's going to be a lot of information covered in the next hour. But the point of this is not necessarily to make you become a tax expert or an accountant or tell you everything you need to know about tax, but it's to give you an overview of the taxes, because when I meet a lot of small businesses, when I talk to them about their taxes, and many of them have an accountant, I don't operate as an accountant for businesses, but I help them with all the things around that. But when I speak to small businesses, they often tell me that tax is something that they don't really understand. They're not sure about it, and they leave a lot of it up to their accountant, which is fine in some respects, but I encourage all small businesses to take a little bit of ownership. So delegate your tax issues to an accountant, but don't abdicate all responsibilities. So this morning is really about trying to encourage you to have a think about your taxes and understand a little bit more than you already do, and maybe point you in the direction of learning a little bit more, finding out a bit more, maybe speaking to your accountant about something or investigating something. So throughout this presentation, there will be links to external sources, a lot of them on the gov.uk website, which tells you all you need to know about certain elements of taxation. We're not going to go on to those links, it would be time this morning, but they will be shared afterwards. And the structure of this presentation this morning is around what is the tax, who is affected, and how do you manage it. So we're going to look at the taxes in that process, in that order. I will also say that towards the end, I will be having a look at it through the eyes of a sole trader and through a limited company, and as well through a partnership. So we're going to look at that we're going to pull all the bits together and say, if you're a sole trader, here are the issues. But we're going to look at the individual taxes first. So what taxes, first of all, do you need to organise? So as Patricia said, the taxes we're going to look at this morning are income tax, corporation tax, VAT. We're going to have a touch on other taxes, and we are also going to have a little look at national insurance, which isn't technically a tax, but it is a revenue, a government revenue that is collected and it's used for various purposes. But we'll talk about those. The first thing I want to mention is the registration for taxes, because no matter what business you are, you do need to register for your taxes. So a sole trader, partnership, limited company, you do need to register in some way. Self-employed individuals, now I'm guessing most of you already are registered. If you're on the line and you're maybe not quite registered, that's the link to get registered. And registering really just registers you for taxes. That's what it does. So that registration process you can go through. If you have started trading, there is a deadline for registering for tax for sole traders. And so if you start your business sometime between the 6th of April one year and the 5th of April the next, you have until the 6th of October that following year to register. So there's a bit of a thing which I call a time lag. And time lag is going to be a recurring theme in this webinar, because I'm going to be talking about that, because that is one of the problems with taxes. There's a time lag between registration, collecting taxes, making your returns, and paying your taxes. And that's the bit that businesses need to manage better, I think. And hopefully you'll pick up some suggestions. Registering for a limited company, again, that's and again, you can see the registration there is for setting up your company for corporation tax. Limited companies can be set up at any time. They don't need to begin trading straight away. But if a limited company is set up and does begin trading, it must notify HMRC within 3 months. So again, there's a bit of a time lag when you set up a limited company. For an employer, if you are going to be an employer, you need to set up yourself as a PAYE employer. Again, there's a separate registration process with that with HMRC. So if you haven't started to employ people yet and you're thinking about it, you should look into what you need to do as an employer. And then there's a registration process for VAT and how to register for VAT. There is, well, it's not on the screen, there is also a separate process for registration for a partnership. You need, and there's separate returns that are required for partnerships as well. So each one of them has their own registration process, and the purpose of those registration processes is to register yourself for taxes, so that the government can collect the money from you by you submitting returns and then sending the money to them. So we're going to start off with, what is income tax? So it's a tax on earnings in your personal name. So a lot of you will be familiar with income tax if you've been an employee, or even if you still are an employee, because income tax is what you pay when you get your salary and your wages. So it's something that is collected and charged after you take your annual personal allowance into account, and for 2023-24, that's £12,750. So basically, income tax is something that an employee pays, and it's collected by the employer, and we'll talk about that separately. Self-employed also pay income tax. So if you're a sole trader, or if you're a partnership as well, you will pay income tax on your profit. And your profit is obviously calculated as your sales less your allowable expenses. And again, you get a personal allowance of the £12,750 before you start having to pay any tax. Also, if you're a limited company and you are a shareholder in that company, then you could be entitled to a company dividend, and you pay income tax on the company dividend. So that's another way where income tax affects, and where it's chargeable to an individual who's in the business situation. Basic rate of income tax at the minute is 20%. Higher rates are 45 and 50%. The other thing, that tax allowance there, the 12,750, was frozen in 23-24. It was the same amount in 22-23, and it's frozen at 12,750 in the year. I think that's down to government needing to maintain their tax revenues. So how's it collected then? Income tax is collected by an employer under the PAYE or pay-as-you-earn system through the employee payroll system, and it's automatic. Self-employed, it's not automatic, and it is collected through the self-assessment tax return. So again, if you've been self-employed for a while, you will understand that the self-assessment tax return is your way of completing information on your business, your income, your expenses, and your profit, and that return has to be completed by the end of January every year. But it's not automatic, and that in itself is one of the problems with business taxation. If you're an employee, your salaries automatically worked out on the basis of your tax allowance, and the tax is deducted at source, and you don't have to do much about it. But if you're self-employed or in business through a limited company or partnership, it's not automatic, and that's one of the issues that you have to manage it differently than how you would manage it if you were just an employee. And then it's paid to HMRC then either by the employer through the PAYE system, and that is usually paid by, in fact, it has to be paid by the 22nd of the next tax month if you're paid monthly. So if you're an employer, then the employer will deduct the PAYE tax from the employee's salary, and then they must, by the 22nd of the following month, they have to pay it over to HMRC. Now the tax month runs the 6th of one month to the 5th of the next. So if you pay somebody at the 31st of July, that is within the period 6th of July to the 5th of August, and that would need to be paid by the 22nd of September. So don't worry too much about the dates. These are all available online, and there will be links to check those up. But the point is there is a time lag there as well for employers who pay their PAYE. But that date is really important, because if you don't pay that and you don't pay any of your tax on time, there are fines and penalties for you. Self-employed pay through the self-assessment tax return for the 31st of January and 31st of July deadlines in the year after the tax year. So tax year 6th of April to the 5th of April, tax return needs to be done and tax needs to be paid by the end of January the following year. And there is also an element of the 31st of July payment there is for an interim payment, and I'll talk a little bit about that in one of the future slides. Partnerships pay do their tax returns through a partnership tax return, and they also have to do a self-assessment tax return for themselves individually. There's a partnership return for the business, and then there's a self-assessment return, which they must do individually for their share of the profits. They must record that through a self-assessment system, similar to the self-employed. And again, the 31st of January and 31st of July deadlines for that. The partnership tax return, I think the deadline for it is the 31st of October in the year after the tax year ends. So who's affected by income tax? You'll have guessed from that last slide, employees, including as a director of your own company. So if you are a director of your own company and you pay yourself a wage, you are an employee of that company. You may well be a director, you may well be a shareholder as well, but you are an employee and you must set up a payroll system for yourself as a director. Again, if you set yourself up, you probably know that that's the way it works. But if you're a sole trader thinking about becoming turning yourself or converting into a limited company, then this is something you need to think about, because you, as the sole trader, you are in the business, you can just take money out, but if you're a director of a company, you have to take it out the way of a salary. And PAYE tax is part of that process. Self-employed are affected by income tax. We talked about as a sole trader, as an employer. Partners are affected as well, both as a partnership and as an employer if they also employ staff. And limited companies are affected by income tax both as employers, and the directors of our shareholders of that company are also affected by PAYE. So it's quite broad. Income tax affects almost every business in one way, shape, or form. So how do you manage income tax? And this is one of the keys. So as an employee, you don't really have to do anything. You should check your tax to make sure that it's being taken out at the right rate. But employees don't have any returns to do or anything like that. It's all taken through the system. As an employer, you do need to manage it. So you have to deduct it from the employee's salary using the PAYE tax code and the rate, and giving them their allowance. And as well as that, you have to submit an online real-time information report. the HMRC at each salary payment date. So that if you have a bookkeeping system, and I'll be talking quite a bit about bookkeeping systems throughout this presentation, you should use a bookkeeping system or some sort of standalone payroll system, either internal or outsourced, to do that for you. Because if you run your payroll through a formal system, the real-time information report, the RTI report, is sent automatically on your behalf. You don't have anything to do once it's been set up properly on your system. You must pay your PAYE by the 22nd of the next tax month, as I said. So salary paid at the end of July, you'd be due to pay that by the 22nd of September. And how you manage that, you set up a direct debit. So this will be a recurring theme in here around managing this, because the time lag between when taxes are taken out and they're paid can be difficult, because the cash that's been withheld from an employee or is recovered from the business as part of your sales invoice or your sales receipts, it's just washing around in your account with lots of other funds. So it's important that you find a way to distinguish that, and I'll talk a little bit about that. Self-assessment then is and how you manage that as a self-employed person, either as a partner or as a shareholder. Earnings in the tax year, 60 April 22 to 23, it's due at the end of 2024, and normally there's a 50% advance for the 23-24 period as well. So you've got two timelines there. When you look at the next line, the remaining 50% for 23-24 is due by the end of July. So if you're a sole trader or you're thinking about setting up a business as a sole trader, then you have to remember that there's two key dates, the end of January and the end of July, and you need to have the money to pay your tax bill at those points in time. And it's important to think about the ways that you do that. So one of the ways is suggested there to build a reserve. So you set aside the funds in a deposit account or a separate account. If you leave it washing around in your current account, you need to make sure you know exactly how much of that is reserved for tax. And it gets a little bit more complicated when you also have, if you're registered with VAT, which we'll come to in a minute. So you can set up a direct debit for that as well, as a one-off payment to pay your tax at the end of January. Or you can set up a budget plan, and not a lot of small businesses know this. You can set up a budget plan, a budget payment plan with HMRC to pay your self-assessment tax on a monthly basis. And that's a good idea if you just want to collect the money, know that you paid it, and at the end of the year, depending on whether you've overpaid or underpaid, you may be due to pay a little bit more, or you may be due a refund if you've overpaid what you should pay. But it's really important to get some sort of system in your mind, and we'll talk a little bit about the overall systems that can be used. So an example of income tax here, just to show you, self-employed, sole trader, their financial year ends the end of March. They have an invoice that they issue on the 12th of April 22 for £1,000. The cost of that to them, whatever they're selling, was £200, and they have approximate overheads of about 50. So on that invoice, well, it's not as simple to calculate directly as that, but we'll talk about it in terms of a good bookkeeping system. A net profit on that sale of £750. Tax is due on that of 20%, which is £150, but that's not payable until the end of January 2024. So you can see there at a glance, there's 9 months of a time lag between, in fact, that's more than 9 months, that's 21 months of a time lag from the invoice is issued. So it's fallen into the 22-23 tax year, but it's not due for another 10 months after that. So the timeline is really important. So if you are in any business and you're generating invoices or you're generating sales and you're getting in the cash and the money's going to your bank account, you've got to be conscious of the fact that some of those funds are tax funds, and you've got to think about how you set those aside. So timeline is the issue, set it aside or pay it early. So we'll talk a little bit now about corporation tax. And again, it's earnings, in this case, in your company name. So I know there's quite a few registered companies on the webinar. Again, it's chargeable on profit. And if you're not a limited company, but you're a sole trader, some of this may be relevant to you because you're thinking about, if you did form a limited company, what are the impacts? And they're just different systems for corporation tax and income tax. So it's maybe quite important to understand the differences. I get asked quite a lot for when you start businesses, what's the best thing to do? Should I set up a limited company or a sole trader? And there is no direct and easy answer to that and no simple answer to that. But one of the important things I explain to them is that they need to understand the different tax systems that work around both of those, and that's where maybe an accountant needs to be involved. But and there are other issues as well in terms of the benefits and advantages, disadvantages of both. But in terms of corporation tax, it's chargeable on company earnings, and it's charged on profit, just as it is for self-assessment, after your allowable expenditure. And there's no corporation tax allowance. You don't get any allowance as you do for personal income tax at 12,750. You pay it on your full profit. Your main corporation tax is 25%, which increased from 19% from April 2023. But there is a small company rate of 19% at the moment, up to £50,000 net profit. And I'm guessing many of the businesses or companies on the line maybe fall into that bracket. And then there's a marginal relief between 50 and 250. So it's there's a above 250, then the main tax rate is 25%. So if you're a small company, profit 50,000, it's 19%, which is 19%, which isn't dissimilar to the 20% on income tax. It's collected by either payments on account, voluntary, direct bank transfer, or bank card. So you can actually pay some of that online. I'll explain how you do that, because it's the HMRC system, the government gateway system, is really important in managing your taxes, because that has a record of all your returns, is a record of how much you owe, and a record of when you're due to pay it. So I'll talk a little bit about that afterwards. So, and it can be collected as well by direct debit, one-off. It's paid by limited companies who are actively trading, i.e. not dormant. So by dormant company, that means a company who actually isn't trading. So you could form a limited company yourself, and you could leave it just on company's house as a company that hasn't started to trade. But once you do start to trade, you've got to notify HMRC within 3 months of that. So if you're not trading, if you are dormant, you'll not have any tax to pay. You will still have sort of company's house returns and that to do, but not corporation tax returns to do. So the corporation tax is paid by limited companies. It's due within 12 months of the company year end. So the return is due within 12 months of the company year end. So, and the corporation tax itself is paid within 9 months and 1 day after the year end. So at a glance there, you can see that you actually have to pay your corporation tax about 3 months earlier than you actually have to put in your corporation tax return. So it seems a little bit the wrong way around that, but that's the way it is. So you just need to, a lot of businesses do their corporation tax return within the 9 months, pay their tax, and that's it. But the revenue allow this period. So basically, what they're saying is that if you haven't your tax return completed within 9 months, you should be paying the tax you think it should be, even if it's an estimated tax. So that's again important if you're a limited company, that you understand that as a time frame and a deadline, because missing those will invoke penalties. So who's affected by corporation tax? Obviously corporations, limited companies, charities who are registered companies as well, whether they're involved in trading, and clubs or community or sports clubs. And there are none of those on this morning as far as I'm aware. So how do you manage corporation tax? So the tax return itself, you need to complete it on time. And I mentioned the government gateway portal. I hope everyone is aware of that. If you're not, that should be one of the actions coming out of this year. Just make sure you're aware of your own government gateway portal. That is a HMRC record of your tax, and it's individual to you. So when you sign into that, it'll have a record of all of your taxes, your business taxes, and any income tax if you're self-assessment. And you've also got a limited company portal, which allows you to go in and check your PAYE if you've got employees, and your corporation tax. So just make sure you're conscious of that, and if your accountant has access to that, that's good. But I'd suggest as well, going back to the delegate, don't abdicate, it would be useful if you yourself could also go in and just become familiar with it. It's not complicated once you get into it, but it does have a full record of your returns, of the return deadlines, and any taxes that are due, and it's good to keep an eye on that. So your tax payments, make sure they're paid on time. And corporation tax anyway within 9 months of the company year end, which is the 1st of October. If your year end is the end of December. The timeline is important, so setting aside some corporation tax when you are paid, and estimating between 15 and 20%. So when I say an estimate of 15 to 20%, if you are a company and you make a sale and it's £1,000, you will have expenses you can deduct from that £1,000 before you actually reach your profit figure. So setting aside a full 200, which is 20% of 1,000, isn't needed. You wouldn't need all of that there for your tax. But some businesses I know do that because it gives them a little bit of a little bit of cushion, if you like, a little bit of extra leeway when it comes to doing their tax and having tax money available. And remember what that you're allowable expenditure. Know what this is, including any capital costs. You're taxed on your profit, not your sales. So be aware of what your allowable expenditure is. And there's a link as well to HMRC website in terms of what your allowable expenditure is. An example of corporation tax, limited company year end 31st of December. Similar to the last example for the sole trader. Sales invoice 1st of January, £22,000. Cost that sale £200. Overheads 50. Again, a net profit of 750. They're taxed at 19% in this case, £142.50. That's payable by the 1st of October 2024 because their year ends 31st of December 22, and that is 22, 23. That actually should be payable the 1st of October 23. I'll get that fixed up. If the year end is 31st of December 22, and we have an invoice in January 22, then that should be payable the 1st of October 23. So apologies about that. It's really 9 months from the end of the financial year end. So it just, again, the issue here is a time lag. So do set it aside or pay it early. It's important you've got the money for this because there can be penalties if you don't pay. We're going to have a look now at value-added tax, see how we're doing for time. We're okay, we're about halfway through. So VAT, now again, we have quite a few businesses online who are registered for VAT and some who aren't. So the key thing to understand about this is if you are registered for VAT, you need to understand what the timeframes are, how it's calculated, how it's worked out. And if you're not registered for VAT, you need to think about what you need to be, what level of turnover you need to have to register for VAT. So VAT is just a tax on the sales made by a business or organization. And you must register for VAT if your total VAT taxable turnover for the last 12 months is over £85,000, which is the VAT threshold. So if you're trading underneath that threshold and you expect you're going to go up it, which is the next bit, so you expect your annual turnover is going to be over 85,000 in the next 30 days, then you need to register for VAT. And VAT threshold is an important element for businesses because once you do register for VAT, then you need to start charging VAT in your sales. Up until that point, you don't need to do that. And that will have an impact on your pricing. So just be conscious of that as your business expands or grows, that your sales, once they reach the £85,000 threshold and go above, you will be expected to register for VAT. There are different VAT schemes, so speak to your accountant about those. If you're VAT registered, I'm not going into great detail here, but there are different VAT schemes. Some of them allow you to do your VAT returns on a cash basis rather than an accruals basis, and that helps with cash flow. But it's on the gov.uk website, and each business should have a think about the scheme that they might be eligible for. There's a thing called a flat rate scheme as well. So you could do a whole session on VAT, but the important bit for anyone who's on the line is if you are VAT registered. If you aren't VAT registered, you need to understand what you need to be, and if you are VAT registered, you need to understand what you need to do with the VAT that you collect and the VAT that you pay. So who's affected by VAT? Self-employed, partnerships, limited companies, whether registered for VAT or not. So why I say that is that if you are in business and you're buying supplies, if the person who's supplying you themselves is VAT registered, they will charge VAT on their supplies to you. And because you're not VAT registered, you will not be able to collect that. So that's why I say you're affected by VAT. So if you're buying something at £100 and there's 20% VAT in that and you're paying 120, then the cost to you and your business is 120, and that will be your expense. That will be what you can offset against your sales. But everybody is affected in some way or other with VAT. And that's what I said at the end there. So in some way or other, you're affected by VAT. But you're not affected by the VAT returns, etc., unless you are obviously registered. So how do you manage VAT? So if you're registered, you charge and collect VAT on your sales at the standard rate of 20%. Now, there are different sub-sales or exempt, and there's zero rated supply and all that type of thing. But as a rule, 20% is what you would pay if what you would collect on your sales if you are VAT registered. And you may pay VAT on your supplies or purchases at a standard rate of 20%. So even if you're not registered, as I've said just there on the last slide, so if you're not registered for VAT, you may well be paying 20% on your supplies. The only time you wouldn't pay VAT on your supplies if your supplier themselves is not VAT registered. So if they're not VAT registered, they can't charge you VAT. So managing VAT, it's important. You're looking at two sides of this. If you're VAT registered, you're looking at the sales side where you collect it, and you're looking at the purchases side where you pay it. And then you pay the difference between those to HMRC after submitting your VAT return, which is usually quarterly. So basically, your role is a tax collector, as it is for PAYE. You collect tax from your business processes, from your sales, and then you pay tax to suppliers, and you're allowed to offset one against the other. Those who are already VAT registered, obviously that'll be quite familiar to you. If you're not VAT registered, but you're thinking at some stage you might be, that's effectively what you're going to be expected to do. So making tax digital, which I will talk about again, is here already for VAT registered businesses. There's a wee question coming up on that, so I'll talk about that later. And there's a link there to the different VAT schemes and rules. So again, that's at the gov.uk website. So if you want to find out a bit more about VAT, I encourage you to go in there and have a look at that. If you are VAT registered, I would still encourage you to go and have a look at it, because just to make sure that you're on the right VAT scheme. Because some people default to the standard scheme, but another scheme may be different from them. And that is something that I would encourage you to speak to your accountant about. If you're VAT registered, just go and check it out. So it may be a conversation you'll have with your accountant as to why you're on the particular scheme that you're on at the moment. A quick VAT example, a VAT registered business. In this case, just a few more figures in this one here. So again, a sales invoice in January 23 for £1,000. They add £200 of VAT onto that. So the total invoice that they issue is £1,200, or the total sale that they generate is £1,200. Again, the cost of the sale is £200, but if they're paying VAT on that, there may be an extra £40 on that. And their overheads again are 50, on which there's again maybe VAT of 10. But the bottom line is still the same net profit of 750. But the point in that particular case is that the net VAT, the £150, which is 20% of the 750, is payable by the 8th of May. So what happens there is the VAT quarter, which runs in this case from January to 31st of March, has to be submitted to HMRC, and it's payable then by the 8th of the following month. Timeline is the issue again for VAT, and again, importantly, is set aside. So if you look back over the last 3 slides, if you're involved in employing people, your self-assessment, or you live in a company, you are VAT registered, there's lots of different tax points that happen in the course of your month's trading. And it's really important to understand all of those and be clear about them, and understand when the money you're picking up includes an element of VAT or an element of corporation tax, or even if it's income tax. And you need to be conscious of that and decide how you're going to manage it. And I will talk a little bit about that when I look through the eyes of the sole trader and limited company in a later slide. So time lag, really important to understand what it is, because if you don't understand the time lags, and the time lags are in the collecting the money, doing your returns, paying the money, all of that, it just, there are days, weeks, months in time between all of those. Really important that you do it. And so I suggest that you keep good records and set it aside or pay it early. So when I say keep good records, I still do meet quite a lot of small businesses who don't have what I would call a formal bookkeeping system. And I'll use this point, I will talk about it a little bit later as well, but it really is important to, if you don't have that, to think about having it, and do that in conjunction with your accountant. Some accountants have a preference for certain systems and prefer certain ones. I personally use QuickBooks myself, but I work with businesses who use Xero, Sage, ClearBooks, QuickFile. There's some free versions of QuickFile that are out there businesses can use. They're cloud-based systems. And the good thing about those is that they can link to your bank account. So you can get your information into your bookkeeping system in real time. I did speak to a business just last week, at the end of last week, and they they don't have a bookkeeping system, but they think their accountant has, that they use for them, but they literally, the accountant does everything for them. They do all the returns, they do all the recording, all the transactions, everything is done for them. But they would admit at no point in time would they have any idea about when taxes are due. The accountant tells them everything. They wouldn't know when the returns are due. They don't know how much they owe, and they certainly have no idea how much profit they're making at any point in time. So I've encouraged them to speak to their accountant about getting access to the bookkeeping system if there is one. And I would encourage anyone who doesn't have a good bookkeeping system to consider. There's a cost to it if you pay for one of the paid versions or select one of the paid versions. But there are free versions out there as well, and they're cloud-based, like a quick file, which I mentioned. Okay, we're going to take a short break now just to have a look, just before we go to the last section of this, just to have a look at a couple of quick polls. And the first one is your involvement in your taxes. And we'll just run that poll now. That's just a question about how much you are involved with your current tax returns and payments. Okay, good mix of answers there. Maybe 20% almost there, leave it all to their accountant, and an equal number do everything themselves and not use an accountant, and then be some in the middle. Very few there look like they could help from family or friend. It's probably good. You're better to have a professional helping you than somebody who maybe is not an expert. And I see the bulk of people there do some themselves with help from their accountants, and that's probably a good mix to have. So if you're very comfortable doing it all yourself, that's absolutely fine. So if you're very comfortable doing it and you don't need an accountant, because you don't need an accountant, you can do it yourself. And in fact, some people are now realizing that having a good cloud-based system increases the ability of the business to consider doing more of their own tax returns, payments, etc., because they have a lot more visibility than they might have had in the past when they simply send a bank statement and some check stubs and receipts into an accountant to do their tax returns. So having a good bookkeeping system would increase the ability of a business to be able to do more of their tax returns and take a bit more ownership of it. Okay, that's good. And the second poll then, making tax digital, which I mentioned, which we'll talk a little bit about. So how aware are you of making tax digital and how it will affect your business? Okay, that's a fairly reasonable spread. Partly aware 43, so we've got very aware 26, which is good. Partly aware 43, yeah. And that could well be, when I talk a little bit about now, that could well be the fact that those who are VAT registered are already involved in making tax digital, because making tax digital is here for VAT registered businesses, but it is coming soon, well, in a couple of years' time for sole traders businesses, and therefore just in context of managing your business taxes, it's worth mentioning it in this presentation, this webinar. So I'll be talking about that. So we'll just go on now to the next slide. Okay. Okay, so I mentioned earlier about having a look at the position from the sole trader's perspective. We had a look at the taxes, we've had a look at the income tax and corporation tax and VAT, and I'm going to just now have a look at it from the sole trader's point of view. It doesn't recap what we looked at earlier, but it's just to try and understand it from your perspective, because you may have looked at the corporation tax stuff and said, not sure that's anything to do with me. So this is sort of something, bringing it together here. So registering for self-employment is registering for self-assessment for tax. That's a government gateway account that we talked about. It's just a bit managing your tax now. So when you get paid, set aside, again, an estimate of 10 to 20% for your income tax. And again, why it's not the full 20% is because you will have the personal allowance, you will have expenses in your business. You don't need to set aside a full 20% of your sales for your tax purposes. Although again, I do know some businesses who do that. They're just being conservative and they're building up a little bit of reserve. So, but I do suggest you do set aside enough of your sales income at the point of sale when you get it in a separate account, so that you have the money there for when you need to pay the tax. Start your tax return early, or tell your accountant, and pay your tax on time. Yeah, I encourage businesses to get your returns started early. I mean, the deadline's the end of January for online returns, but accountants are really, really busy in January. And I remember coming across a story where there was an accountant told me that no, it was actually the client told me that he was trying to get his accountant, and he tried phoning him, emailing him, couldn't get through to him. Called around to his offices and all the blinds were down. It was like the middle of January, and he would have given some information and find out where his return was going. And he rang the accountant from outside, still no answer. He knocked the door. Eventually, the accountant came down, let him in. The accountant was working in the office with the blinds down. He said it was the only way he could get his tax returns done in January. He had to just close down all his emails, not answer anything, get them all done. So you don't want to be in that category. Accountants do encourage businesses to try to start them early. Good cloud-based systems allow that to happen because you can give your accountant access to your cloud-based system online. And then that means that the information is already readily available to them. If you prepare your tax returns with paper and spreadsheets and bank statements and things like that, it's going to take your accountant more time, and indeed probably will charge you more for that if you're going to do it. So start your return early and consider a good cloud-based system that allows the accountant to get access to the information very quickly. Add key dates to your diary. Remember, there are penalties. Yes, this is another element that I'm going to recommend. So as well as getting a good bookkeeping system to record everything, as well as going into your government gateway account regularly to see exactly what your tax position is, as well as setting aside the money for the taxes when they're due. I also suggest you have a good diary system, and you put those dates into your diary, the deadlines for the returns, the deadlines for the payments when they're due, so that now you may be able to remember all this. If you are, that's absolutely fine. But I certainly put reminders into my diary to tell me when my taxes are due, when my returns are due, and it's important just to have that system built in. Also, if you're a sole trader and an employer, again, you'll be registered as an employer with HMRC. Again, you'll have to set up an online payroll system or use a bookkeeping system like QuickBooks Xero, Sage, or QuickFile, the free version that I mentioned. You need to collect the pay as you earn and national insurance for your employees. Set up a direct debit or pay it directly on time. Check your government gateway account regularly, at least monthly. So again, if you're a sole trader, there's a quick checklist of things you need to think about doing and pulling them all together. You don't need to be a tax expert to understand how you manage your taxes. You need to have just a system, a process, and a structure for that. And that's one that I recommend there for sole traders. For a limited company, something similar. Setting your limited company up is like registering for corporation tax through the government gateway system. Again, when you get paid, set aside 15 to 20% for your taxes. Start your tax return early, add the dates to your diary, and get a good bookkeeping system. They're similar to a sole trader, just the dates are different, the rates are different, some of the allowable expenditure is different. Also, if you're an employer similar to a sole trader, you need to register with HMRC. If you have already registered, then you're probably familiar with the system. Setting up an online payroll system, so you can set up a separate system. HMRC have their own payroll systems, which you can use for free. Or you can use the payroll system that's built into the bookkeeping systems like QuickBooks Xero and Sage. And then you collect the PAYE from your staff and the national insurance, set up a direct debit or pay on time, and again, check your government gateway account regularly, at least monthly. So do you recommend something similar for limited companies as for sole traders? As for partnerships, what you've read there for sole traders, very similar to your own. So if you're a partnership, it's going to be the same. Just get the dates in your diary for your partnership tax return, which again, I think is the end of October, and the dates for self-assessment returns at the end of January, and any payments that need to be made. Very, very similar. So managing your tax and VAT. So register again for VAT. When you get paid, set aside 15 to 20%. So again, you don't have to set aside the full 20%, but some businesses do. And the reason for that is you will be allowed to deduct from any tax you collect the tax that you pay on your supplies. So it's not the full 20%, but some people do it as a rule of thumb. They just set it aside and have it there, and it's always available, and there's a little bit of reserve built into that. But if you can't afford the reserve, at least set aside the amount that you think it's going to be. Start your VAT return early or tell your accountant, get a good bookkeeping system, direct debit. So very similar to managing your tax for sole trader and limited company. So the theme is the same. Using the government gateway, setting up a diary, getting a good bookkeeping system, liaising with your accountant, setting the money aside. and paying on time. All of those things are right across all of the taxes, even though they're different. Quick mention of other taxes. Some of these aren't necessarily business taxes, but I'm just putting them up here to be part of the presentation. Capital gain taxes is a tax on profit when you sell or dispose of an asset that's increasing value. So like a property is a typical sale. If you sell a property in business, then you will pay capital gains tax on it. Capital gains tax is not charged to limited companies. They pay through their corporation tax system. So again, a little bit of a quirk in there. Inheritance tax is more for personal thing. I just put it in there for the benefit of people seeing it. And then stamp duty or land tax payable when you buy a property or land over a certain price in England. So you maybe aware of stamp duty when you're buying and selling houses. It's not payable on main homes, residential homes. I want to mention national insurance contributions, as Patricia said, not quite a tax, but quite important to mention it because it is something that employers need to pick up and the self-employed. So I just put a table up there. I'm not going to mention it in great detail, but just there's 4 main classes of national insurance contributions there. I've highlighted a couple. The class 1 is where you're an employee. That's what you pay as an employee. The employer also pays a class 1 contribution. And that is a contribution really towards the pension of an individual. A class 2 is also a contribution towards the pension. It's collected through your self-assessment system, so you don't need to calculate it. It's done as part of your self-assessment tax return. And again, you should be conscious of that and speak to your accountant about that, because that should be that'll be automatically calculated, as is class 4. You'll see at the bottom there the self-employed earnings profit of that or more years collected through self-assessment. So there's a threshold before you'd start paying your class 4 national insurance contributions. Just important that you know that and know the impact of it. I'll draw everyone's attention there to class 3, which are the voluntary contributions to fill your gaps. So that's been in the news recently, because your national insurance contributions will dictate how much state pension you get. So that class 3 contributions are ones you can make where you have some gaps. And I would encourage everybody here who is approaching or is just interested in their state pension, you can check it on that link there, the gov.uk check national insurance record. You can go in and check what your contributions are, and you can see if there's any gaps in your contributions, because those gaps would reduce the state pension you're entitled to. And there's an option, depending on time limits, to go in and make some voluntary contributions to close those gaps. So I'm just mentioning that in passing, just an important thing to understand when you're in business as well, because when you're in business, if you're not an employee, then your self-employed contributions, class 2 and class 4, are what are used to contribute towards your pension. So the key steps in any taxes are first of all, you register, then you collect it, then you complete a tax return, and then you pay the amount, identify the amount you have to pay, and then you pay it. And the issue there is, of course, time lag right across the whole process. So, but there's just those main key steps in terms of all the taxes that we talked about this morning. I did say I would cover paying yourself. A lot of people ask me, how do I pay myself if I'm self-employed? How do I pay myself if I'm a director of a company? So we'll put those up there. Self-employed, you withdraw from your bank account after setting aside your tax. You can just take it out directly from your bank account, and it's called drawings. A limited company is different. They have to set up a payroll system. They have to be a payee, or sorry, an employee, and they pay themselves a wage. And it's the wage itself is tax deductible by the business from its as an expense in the business. And if you're a shareholder as well in a limited company, you pay yourself a dividend annually or as agreed with your accountant. And remember to set aside the income tax during this. So if you pay yourself a dividend, the income from that dividend that you get will be part of your self-assessment tax return. So these all overlap. There's some little silos here and there, but by and large, a lot of these overlap. If you're a partnership, you pay similar to a self-employed person there. You'll just withdraw the money from your bank account, and it's treated as drawings. A couple of quick mention of some upcoming tax changes. The first one we've mentioned is making tax digital. I want to mention that because it's really, really important. It's already in place, as I've said earlier, for VAT registered businesses. And from the 6th of April 2026, most sole traders with turnover £50,000 are going to be have to register and go through the Making Tax Digital system. From the 6th of April 27, it's going to be extended to sole traders with turnover over £30,000. There's a link there on that just to explain a little bit about it. But what it's going to do is going to change the way the whole self-assessment system works for sole traders. So rather than have an annual tax return at the end of the year, end of January, you're going to be doing a quarterly tax return. You're going to be paying your tax quarterly along with that, and you will have to do it all digitally. So you're going to have a good bookkeeping system or a good online system that does that, because it's not going to be done on a separate system through the government gateway process. So it's going to be similar to the way the VAT system runs at the moment. So you may think that's a long time away, April 26. It's not that long away, and you might be better at least reading up on it, understanding it, and getting prepared for it. So those of you who said you didn't know much about it or you weren't very aware of it, just go and find out a little bit about it. It'd be just a good thing to do after the webinar at some stage to go and check it out, or talk to your accountant about it and say, how's that going to affect me? But again, it's push businesses towards getting a good bookkeeping system. This next one here, I'm going to touch on it very lightly. There's a thing called changes to tax year basis periods. Very technical, a little bit heavy for the end of this webinar. But basically it's going to do, if you need to check if your financial year end at the moment is not the 31st of March or the 5th of April. If it's outside of that range, so if it's the end of December, and this is if you are a sole trader or a partnership, you just need to check if it is outside of that, there's going to be an impact on you. So if your year end is the end of April or the end of September or end of December and you're a sole trader or partnership, talk to your accountant about that, because there's going to be a change coming up that's going to affect you. So quick note, tax rates, rules change. Always check the latest information on the relevant gov.uk website and with your accountant. So what I'm covering today is relevant as of today, but things change all the time. There's budgets every year, rates change every year, and it's just a matter of keeping up to date with those. So quickly now, just how to manage your taxes, your next 5 steps. Identify what taxes you may be liable for. Register on time for each tax. Collect and set aside or pay your taxes as you go along. The timeline is a big important issue. Submit your tax returns, pay your taxes before the deadline, and engage an accountant if you aren't sure, if you don't have the time. But I would say there at the end, you know, and a lot of you are already doing all of this yourself, which is good, just as long as you make sure you're doing everything right and you're claiming all the things that you should, and that you don't, at one extreme, abdicate all responsibility to an accountant where you don't have a clue what's going on. I encourage businesses to take some ownership and some responsibility for that. Just a reference there to CNI existing support. There is a link, I'm sure a lot of you are familiar with it. There's a business guidance and business support, financial support link there on the TNI website. Lots of information, some webinars from me and some tips from me. There will be some tips coming out alongside this this webinar, which is a summary of some of the things that are in the presentation. And but it's also useful there to check the actual TNI website. And that's me. We're almost at 11. I'm conscious that we have some Q&A time, but that was a lot to cover in that time. So thanks for your time. I will be taking some Q&A. There may well be some questions already in the chat, which I'll check out now. But that's us for now. I'm going to try my camera again here and see if it's going to work.
Thanks so much, Tony. Yes, I was just going to say there, worth maybe trying it again. Oh yes, great. Just literally as we went live, the picture went pixelated. So you know, that's always the way. But no.
Yes, did it.
Thank you. Not at all. Thank you so much. And as you had already pre-warned me, lots and lots of information to take in there. So hope everyone's been paying attention. Now it's time for our test. No, only joking. But yes, so we will be asking questions to Tony, as he mentioned. So if you do have a question you haven't popped in the chat just yet, then feel free to pop it in now. And as Tony's been going through, the guys behind the scenes have been adding all the links Tony's been referencing during the session, so they're all in there as well. But also we will be uploading the slides and a useful top tips document that Tony's pulled together with all the links in it as well. So don't worry, you will have access to those afterwards as well. So we'll also be sharing a recording of today's session once we have that ready to go and online. So keep an eye on your inbox over the next couple of days, because we'll send everyone who's registered for today, we'll send you along a link to that recording as well. So you can watch back, or if there's a bit that was particularly relevant to you, you can you know, you can jump in and re-watch certain sections of it as well. There's lots and lots of information there this morning. So recordings and information about upcoming sessions all can be found at tourismni.com/TED, and I'll be talking about that a wee bit more just in a wee minute or two. So just before we get stuck into your questions, I'm going to do two or three more very quick polls. You're all dab hands at that now after the polls during the session. So I'll just bring the first question up now, which is, how would you rate today's session in terms of overall satisfaction? So that would be with 1 being not satisfied at all and 5 being extremely satisfied. I'll just give you guys a second or two to complete that. Also, it was a long and full-on session today, so thank you. I can see pretty much everybody is still with us, so you maybe want to hear the Q&A, so thank you so much for sticking with us. Second question, just at the end here, is if you could rate today's session in terms of the content and relevance to your business. So 1 being not relevant at all and 5 being extremely relevant. Just give you a second to select one of those. Okay. Thank you. And third and finally, this is a very simple yes and no question. Just do you plan to take any action in your business as a result of what you've heard from Tony today? I really appreciate you taking the time to do this. It helps us with scoping up our future TED activity. So just that couple of minutes is a really great help for us. So brilliant. Thank you so much. And Tony, now we can see you in full colour and vision. We'll maybe get stuck into a couple of questions here. So the first question I have here through this morning is, what is the best way of keeping track of and controlling your business taxes? Is there a short top tip you can give on that one?
For what was it? For
what
managing?
Is the best way of keeping track of and controlling your business taxes?
Yeah, I think I tried to cover it in the webinar, but in terms of just a very quick thing, the one thing I would recommend, if I had to just say one simple thing, it would be to have a good bookkeeping system. Because if you don't have something that's keeping you up to date, if you're trading in the course of the year and you are coming to the end of your year and you don't know how much profit you're making, you not know how much tax you've got to pay in 9 months' time or in 12 months' time or whatever, and you really just need to have a good, if you have a good bookkeeping system, you can keep track of it. Again, if you've got a digital system and you've got you're registered for VAT, you know, if you go into your balance sheet on your bookkeeping system, it'll tell you at any point in time, as long as it's linked to your bank account. And I have seen people with a bookkeeping system that isn't linked to their bank account. So I'm saying, if you have a cloud-based system, do link it to your bank account, because it'll bring all your information in real time. It will show you in your balance sheet exactly how much VAT you owe. You can do an estimate if you look at your profit and loss account of how much tax you're due. So if your profit for 6 months is £10,000, quick glance, you'll say, do you know what? I probably have to have at least £2,000, 20% of that set aside for my corporation tax, self-income tax. So having a good bookkeeping system. I would say a secondary one then would be to make sure you're familiar with the government gateway. And just go into that and look at that, because that will tell you definitively how much you owe, when you owe it, and it'll tell you what your previous returns were, and it'll tell you everything you need to know as in real time about what the current position is. So good bookkeeping system with a supplementary, make sure you have access to the government gateway account and you look at it regularly.
Brilliant. Thank you so much, Tony. That's a good snapshot. And then, okay, we have one here saying, oh, what happens if your taxes are due and you can't pay them at that stage? What if you can't pay your taxes when they're due?
Yeah, the HMRC have a scheme called Time to Pay. And you can go onto their website, our gov.uk website, and check it out. And it does allow businesses who can't pay their time. The first thing I would say, as soon as you realize you can't pay your taxes, speak to your accountant if you have one. If you're doing them yourself, you know, get in touch with HMRC and tell them, explain to them. They are open to setting up repayment plans and schemes and that, but they don't like to find it out by accident. They don't want to find out. So if you know when your payment, especially if you know your payment is coming up, to tell the revenue in advance, I can't pay that. Don't wait until it's overdue and hasn't been paid and you're getting letters out and you're explaining you can't pay it. So that's why, you know, when you do your return or you're collecting your money, because tax, the way business taxes work, well, there is a time lag. You know, by the time your tax return is due and your money is due to be paid, you should have the money in your bank account. That should be there. You don't have it. It's been spent on something else is the problem. So I would encourage people to read about the time to pay. If they can't, speak to your accountant and speak to HMRC.
Yeah, I suppose it's, yeah, don't panic and wait till you're getting those overdue letters. I think that's it. It's probably face up to it as soon as you realise it's going to happen. Absolutely. That's good advice for lots of things in life, isn't it, Tony?
Yeah. Don't bury your head.
So we have a question here. Someone wondering if they can offset a van or car payment on your taxes, or if they have 2 short-term holiday rentals. Is that something you can advise on at all?
Well, normally the HMRC rules allow for expenses that are called wholly and exclusively, so totally and exclusively for the purposes of the business. So that's the principle that needs to be followed. So if the van or car payments were entirely 100%, part of the business, then you could think about that. In most cases, if it's some part-time holiday lets, it's unlikely there's a van or a car that's entirely used for that. So that's probably unlikely. One thing that, but again, speak to your accountant about that, because there's probably broader issues there that I'm not aware of. But one thing I would suggest that as a possibility is to consider the tax allowed mileage rate that is allowed by HMRC, which is the 45p a mile. So you can claim your travel costs, which includes all repair, etc. But if you travel 100 miles on business and you record that, then you can claim £45, so 100 times 45p, £45 as part of your expenses in your business for running those holiday lets, if that's what they are. And you're allowed to do that, and there's no impact. So that £45 you claim is a tax expense. You can deduct that from your income, so there's less tax to pay if you do it that way. Because most businesses either apportion the costs of their cars or vans between personal and business use, or they claim the 45p a mile for direct business use and keep a record of that. But my quick reaction to that is it's probably not possible, but the 45p a mile might be an option. I did meet somebody last week actually who has been running the business for 2 years and does a lot of traveling and had never heard of the 45p a mile, and the accountant never told them about it. So they're a way they have records of the mileage they did, so they can go in and retrospectively go in and claim that, go in and start adding that up and say, can I add that to my tax return as a cost?
Oh, very good. Yeah, great. We have a question here. Someone wondering, is tax relief for mortgages available against holiday accommodation, which is let on a daily basis? Is that something you could advise on at all?
Tax relief for mortgages isn't really available except in the form of what's called a tax credit. So the tax credit is worked out on the basis of the interest that somebody might pay on their mortgage, and the tax credit is allowed at a rate of 20% of that. So maybe sounds a bit complicated, but basically if you have a mortgage on a property that's a buy to let and the interest on that says £10,000, you can claim a tax credit of £2,000, so 20% of that against your rental income. So that's how it works. It was all changed some time ago, and it's some people have said it's the reason why some buy to let landlords, aren't, there's not as many of them, and why some of them have sort of exited the market, because the tax reliefs aren't as good. But I think that's what the person's maybe asking about. So again, I'd refer them to their accountant just to be specific, but at least that will give them a conversation to talk to their accountant about.
Yeah, a starting point. Brilliant. Well, thank you so much. I think we've covered most of the questions that have come through today. So thank you so much. I hope everyone has found that session really useful. Also hope that we'll be able to welcome a lot of you back again next week when we have our second finance session, which is looking at how to fund your business. So in the current climate, I think definitely a lot of us will be benefiting from some of your wisdom on that one, Tony. So it should be up on your screen there. So there's details for today's session, which of course, as I said, will get up online the recording and the slides from today as soon as possible. And then next Thursday morning, we'll be welcoming Tony back again for that How to Fund Your Business session. We've also just this week opened registrations for our second wave of TED Experts webinars, which are going to be looking at digital hot topics. So they're taking place in early December. So kicking off with embracing AI for growth and efficiency in your tourism business on the 5th of December. And then on Tuesday the 12th, we're going to be looking at new digital marketing trends for tourism businesses. So should be some interesting insights there. That'll be from Kieran Connolly at Profile Tree, who we've worked with before as well. So looking forward to what Kieran has to say on that. And then finally, just a reminder that we're currently halfway through our series of in-person roadshows on Embrace the Giant Spirit experience development. So we've been to Enniskillen and Belfast so far, but if you haven't joined us, there's still time. We're heading to Newry on Monday, and then the following Monday we're up to Derry, Londonderry. And what we're also going to do when we're up there on Monday the 23rd is do a live stream of that session. So if you really wanted to join us live but can't make it in person, you can join us virtually for that one. So information for all of those upcoming sessions is at tourismni.com/TED. So head there for full details and to register. So I think I've kept you all long enough. Thank you all for sticking with us. And all that remains is for me to say thank you so much, Tony. A jam-packed but very useful session. Look forward to seeing you next week again. And also thanks to Barry and Jordan, who've been behind the scenes running all the polls and putting all the links into the chat and everything and keeping it running smoothly. So thanks, guys, and see everybody next week, all being well. Thanks so much. Cheers. Have a good one.
Thank you. Bye.